The gold standard U.S. government bonds. Let's talk about U.S. government bonds, folks. These are the investments that keep America running. Think of them as loans you make to the U.S. government. You lend them money, they promise to pay you back with interest. What makes these bonds so special? They are considered one of the safest investments in the world. Why? Because they are backed by the full faith and credit of the United States government. That means Uncle Sam is guaranteeing your investment. It's like having a money-back guarantee from the most reliable entity on the planet. Now, let's dive into the different flavors of these bonds and why they matter to you. Buckle up, this is going to be a wild ride.
Treasury bonds, a buffet of options. U.S. government bonds come in different shapes and sizes, each with its own delicious flavor. Let's break down the menu, shall we? First up, we have Treasury bills, or T-bills for short. These are the short-term offerings maturing in 1 year or less. Then we have Treasury Notes, affectionately known as T-notes. These bad boys mature in 2 to 10 years. Finally, we have the granddaddy of them all, Treasury bonds or T-bonds. These are the long-haul investments, maturing in 20 to 30 years. Each type of bond comes with a different maturity date and interest rate, so you can pick and choose based on your investment goals. It's like building your own investment sundae.
Born to be sold, the issuance of U.S. bonds. Ever wonder where these bonds come from? It's not some magical printing press in the basement of the Treasury Department. The U.S. Treasury Department issues these bonds to raise money for various government activities. Think of it like a giant bake sale, but instead of cookies, they're selling bonds. The Treasury holds auctions where investors, both big and small, can bid on these bonds. The highest bidders get the bonds, and the interest rate is set based on the auction results. It's a fascinating process that ensures a fair market for these essential financial instruments.
Bond Pricing 101, Unlocking the Yield. Now, let's talk about bond pricing. It's not as complicated as you might think. Imagine a seesaw. When interest rates go up, bond prices go down, and vice versa. Why is that? Well, when you buy a bond, you're essentially locking in an interest rate. If interest rates rise later on, your bond becomes less attractive because investors can get a better return elsewhere. This is where yield comes into play. Yield is the return you get on your bond investment. It's calculated based on the bond's coupon rate, the interest rate it pays, and its market price. Understanding yield is key to making smart bond investments. Section 1. The Bond Bazaar. Where treasuries trade. Where do all these bond transactions take place? Welcome to the bond market, a vast and bustling marketplace where trillions of dollars change hands every day. This isn't your typical stock exchange with ticker tape and yelling traders. The bond market is largely electronic, with institutional investors, governments, and individuals buying and selling bonds through a network of dealers and electronic platforms. It's like a giant online auction, but instead of Beanie Babies, they're trading bonds. Don't worry, you don't need a Wall Street fat cat to navigate this market. You can easily buy and sell treasury bonds through banks, brokers, and even online platforms. Section 2. The Taxman Cometh, Uncle Sam's Cut. Now for everyone's favorite topic, taxes. The good news is that the interest you earn on U.S. Treasury securities is exempt from state and local taxes. However, you're still on the hook for federal income tax. But hey, it's a small price to pay for the security and stability of these investments, right? Just remember to factor in the tax implications when making your investment decisions. It's always a good idea to consult with a financial advisor to optimize your tax strategy.
Section 3 bonds, the bedrock of your portfolio. So, why should you care about US government bonds? Because they're not just for Wall Street hotshots. They are an essential part of a well-diversified investment portfolio for anyone, from seasoned investors to those just starting out. Think of bonds as the steady eddy of your portfolio. They provide stability, income, and a hedge against inflation. While stocks might be the flashy sports car, bonds are the reliable family sedan that gets you where you need to go. Remember, diversification is key to mitigating risk and achieving your long-term financial goals, and bonds play a crucial role in that strategy.
US government bonds are more than just investment vehicles. They are powerful tools that the Federal Reserve, our nation's central bank, uses to conduct monetary policy and steer the economy. By buying or selling bonds in the open market, the Fed can influence interest rates and control the money supply. Lowering interest rates can stimulate economic growth, while raising rates can help curb inflation. It's a delicate balancing act, but one that has a profound impact on our daily lives, affecting everything from mortgage rates to the prices we pay for goods and services.
The bond market, like any other market, has its ups and downs. From 2020 to 2025, we've seen some significant swings in bond yields and prices, driven by a confluence of factors, including the COVID-19 pandemic, geopolitical tensions, and of course, inflation. The pandemic initially sent shockwaves through the market, causing a flight to safety that drove bond yields to record lows. However, as the economy began to recover, inflation fears took hold, leading to a rise in yields. It's been a wild ride, and understanding these trends is crucial for making informed investment decisions. Predicting the future is a fool's errand, especially in the financial markets. However, several factors suggest that interest rates will remain elevated in the near future. Inflation, although showing signs of cooling off, is still a concern for policymakers. The Federal Reserve has signaled its commitment to keeping interest rates higher for longer to ensure that inflation is tamed. What does this mean for bond investors? It means that we can expect continued volatility in the bond market. However, it also presents opportunities for investors to lock in higher yields. In a world of economic uncertainty and geopolitical risks, U.S. government bonds remain a beacon of stability and security. They are the bedrock of the global financial system, the instrument of choice for investors seeking a safe haven for their capital. While the bond market may have its ups and downs, the long-term value and importance of U.S. government bonds remain unquestioned. So, whether you're a seasoned investor or just starting, consider making U.S. government bonds a part of your portfolio. They are a sound investment in both your financial future and the future of our nation. And that's a buy and hold recommendation you can take to the bank.